Here with a look at what to expect from bank earnings is Mike Mayo, an analyst with Wells Fargo Securities. All right, Mike, we know bank earnings tend to set the tone for the rest of earnings season. What are you expecting for the first quarter from JP Morgan and Citigroup?
Well, our theme on large banks is Goliath is winning, meaning you're seeing the benefits of scale more than ever before. So from JP Morgan, Citigroup, and the bank group as a whole, we think you'll see positive operating leverage. Revenues growing faster than expenses. And we think that's not just for the first quarter, we think it's for the entire year and the next few years.
And when it comes to Citi specifically, there are questions on the future of Chairman Michael O'Neill. Seems like he has some sort of mandatory retirement at the end of this year.
Absolutely. So it's not just about the earnings that are coming up, it's also about the annual meeting for me. So I've attended Citigroup's annual meeting for the last 5 or so years. And that's one of the key questions I'll be asking. The chairman of Citigroup steps down at the end of this year. The question is, who takes over the chairman role? Does the CEO get that chairman role? And what else happens? So I brought some props here, Scott, if it's okay.
See 'em.
So first, it's the 20-year anniversary of Citigroup. So we say Citigroup 20-year anniversary, and now the next 20 years. The last 20 years have been lousy. The stock price is down 80% at a time when the stock market has doubled. And now you have a change in management at the chairman level. So I'm going to the annual meeting with my share of stock. Here's my physical copy of Citigroup stock. April 24th in Chicago is the annual meeting. And I want to know who's going to be chairman of Citigroup. And one of our thoughts is, why not someone like Gary Cohn to become chairman of Citigroup? Or there's a lot of other talent out there.
Harvey Schwartz,
and many others. So is Citigroup fully considering these other individuals to become chairman, in addition to, the current CEO, Mike Corbat, and perhaps some other people? So, and I think it's a right question for shareholders to ask. I go to this annual meeting because the stock has performed poorly, and I think it's up to us collectively to keep the pressure on Citigroup, especially since their market value is still well below where it was before the financial crisis.
Would you be okay with Michael Corbat taking on that chairman role?
I'm torn on Michael Corbat taking over the chairman role at the current moment. Citigroup missed some of its prior targets. They were actually 5 years behind on their target for return on assets. We're wondering about the growth story. Having said that, we give the CEO, big credit for reducing the risk at Citigroup. So the last 20 years where Citigroup basically, would have failed without government assistance, that's not happening anytime soon. Citi's de-risked in terms of the leverage, the clients they deal with, the proprietary activities. So big points for Mike Corbat for that. But to get to the next stage for sustainable growth, I think some of the jury is out, and that's why the stock price so far has underperformed in 2018. Having said that, we are big fans of Citigroup stock here, so I am recommending the stock. I just wonder if they could do a lot better with a bit more intensity. And
when we look back 20 years ago, the Citigroup acquisition of Travelers, I can't imagine you were a fan of that one.
So our theme for Citigroup when they merged in April of 1998 was Noah's Ark, because they brought two of everybody along for the management positions. There were two CEOs, two heads of different areas. And day one of that Citigroup merger, the market value of the combined firms went up $30 billion. That's day one. Citigroup stock went up 25%. This was going to be the deal of the century, and here we are 20 years later, and the stock's down 80%. So I think it's fair for me to go to the annual meeting and ask some reasonable questions about, okay, well, we have another change at the top at the board level. How are you going to ensure that the stock and the fundamental performance improves ahead?
Do you think you'll get an answer on April 24th?
Sometimes I get answers, sometimes I don't. I think they have to give some answer about their plans for the chairman, even if it's simply to say, well, we're going to consider the current CEO, we're going to consider people outside. But again, I think they owe it to themselves. If Gary Cohn is free, how could Citigroup not consider Gary Cohn for the chairman position or some other position at Citigroup?
Let's move on to Goldman Sachs. We know how much they rely on trading revenue, and with volatility non-existent in 2017, that impacted their numbers. And they, of course, blamed that. Now, with volatility back, I think the pressure is on for Goldman to perform in the first quarter. Do you agree?
Well, Scott, you can't have it both ways. So what I do in my spare time is I read these annual reports, and you read Goldman Sachs' annual report, and they said, hey, we're doing well, but we would have done better if we didn't have such low volatility. Well, newsflash, volatility is up in 2018, so you can't blame your results for lack of volatility one year and then not benefit from that improved volatility the next year. So we are also bullish on Goldman. We are bullish on the banks now. We think banks are hardwired for additional safety, but Goldman Sachs, better volatility. We expect them to have better earnings. By the way, if we're wrong about our call on Goldman Sachs, I'll take the blame, I'll own it, but I'll also be holding Goldman accountable because they've been waiting for this increased volatility for quite a while.
And then one thing we haven't talked about is, of course, technology when it comes to the banks. We know Bank of America, which will get their earnings sort of later in the season, they're unveiling this new AI-powered chatbot called Erica. I guess what does that mean for the stock?
Well, first of all, the industry, the banking industry is moving to a new stage of technology and the use of technology, and this is really exciting. Maybe I'll be cooler than just a bank analyst. Maybe I can become a tech analyst one day. But what's incredible is Bank of America has 100 million digital mobile banking hits every week. You talk about who are the big fintech firms. Well, guess what? Bank of America is a big fintech firm, and they're in midstream rolling out their chat box, artificial intelligence, called Erica. That's the last part of Bank of America. And if you're a mobile banking customer, you can sign up for that. It started off in Rhode Island, and it's been expanded to a few more states, and they're rolling it out everywhere. But this connects over 100 internal applications to give customers answers. And we think this is an example of the largest national banks really leveraging their scale. Bank of America spends $10 billion on technology every year, and here's a benefit in terms of their digital banking and all the hits. And we think that Bank of America and the large national banks are at a tipping point for the benefits of scale and technology on their business.
They all want to lead on the tech front, the banks.
Yeah, I mean, at some point it's a race, who's spending more on tech. Ultimately, it's what's the benefit to the customer. But look, customer acceptance of technology is better than ever before in the history of the world. Banks' use of technology is more than it's ever been. So you combine the two, and this is the tech era for banking. And the biggest fintech players are the banks.
But the technology stocks have, of course, taken a beating over the past couple of weeks. Do you see more of a rotation out of tech and into financials? Will financial stocks become the leaders of the market in the coming weeks?
Well, we think financial stocks, at least the banks themselves, should become more of a leader in the market. The fundamentals of banks are very strong. The benefits of scale through positive operating leverage, credit quality remains good, additional capital return, and the most often forgotten point, de-risked from a decade ago. Here we are at the 10-year anniversary of the financial crisis, and bank balance sheets are the strongest they've been in a generation. So, we are quite bullish, Scott. As you know, I was, very bearish before the financial crisis. And frankly, the banks over the last 10 years, 20 years, haven't done so well, and we think this is a structural breakout for the large banks. And
not to mention a Federal Reserve that's finally starting to normalize policy.
Look, there's cyclical considerations, and that helps banks more than it hurts, and that's what everybody debates. And what's happening to interest rates? No one predicts interest rates well. And deregulation, you can try to quantify, which is tough to do, and revenues it might pick up, but you spend all your time on cyclical factors, look at the structural factors. I've been covering the industry for 30 years, and these structural factors are breaking out more and better than ever before. And that's what's underappreciated, and that's what I spend my time on. That's what I like spending my time on. That's why the developments of Bank of America with mobile banking or Citigroup, getting some benefits of scale are exciting.
So this is a complicated sort of issue, but as we celebrate 10 years since the financial crisis, is the banking sector stronger overall in your view than perhaps 2006, 2007?
Well, celebrate is a tough word when we say celebrate the financial crisis. I think we remember, because we remember the financial crisis so that we don't repeat the same mistakes. But absolutely, the financial sector, the banks, are far stronger than they were a decade ago. And that's based on more capital, more liquidity, more oversight, and more activities that are client engaged versus, say, proprietary trading.
All right, Mike Mayo, we'll leave it there. A lot of great analysis. Thank you for coming by.
Thanks for having me.